the options white paper by Jason DiLorenzo. We're going to talk about it today. We're going to get into a study of dealer Gamma, Vanna, Charm, among other things. Jason's going to explain it. Mark and I are going to ask the questions. So be ready for the opening bell and the Trader's Workshop. Hey guys, good morning.
Lex, how you doing?
Merry Christmas week. Good to see you. Do you find that the holiday weeks are very slow, or are you guys busy as can be? Mark and I come from a different perspective, being floor guys, but let's hear it from Jason first.
Well, it depends because you also have like all the end of year stuff, like closing book kind of stuff.
Right.
So there's that, but when it comes to markets, it's usually a lot lighter. But then that can mean big moves if somebody decides to feel so compelled.
Are you saying like the big move we had yesterday that went through my short put strikes? That move?
Oh, it killed me too.
That move?
That was no. I mean, we could talk about that one.
Yeah, that was interesting. I want to know what your thoughts are there. But I got to tell you, Mark, I had to trade like a champion yesterday. Whew, that put me to the limits.
I've been impressed with the volume like the last couple days. Like we've actually been, I mean, yesterday was over the yearly average. Tuesday was over the year. Like we're putting up good numbers for December 20s.
Yeah, I totally agree with that. So I think, OCC daily volume for 2023 is on average is about 44-ish million, right, Jason? Somewhere in that ballpark.
Yeah, but yesterday was 55 or so.
Yeah, so they're putting up monster numbers, man. It's above average for the most part, most of the week here. Yeah. I think we're gonna have another big day today, right? With this market kind of snapping back.
Tuesday was a kind of snoozer, and it was 47 million.
Yeah, right. Unbelievable. Okay, Jason, what can you say relative to your metrics about yesterday? That was a little surprising. It seemed like a sleeper, just kind of drifting around, going to be a typical Christmas weekday, and then all of a sudden, kabam.
Yeah, I mean, so the one thing that I was kind of talking about, I think I talked about it on the show a little bit, is SPX was in positive Vega. And, when it's positive Vega, that's not a place where dealers want to be. They want to be negative Vega because they like to warehouse that risk a little bit and maybe collect a little bit on the variance risk premium. Mm-hmm. So they've been like that now for the past couple of weeks at a pretty large clip. And then, so I think yesterday was VIX expiration. And I think that was a good time for them to, unwind their VIX hedges, and they had to kind of re-hedge the little bit of Vega that they actually hedge.
Right.
They had to re-hedge out. So I think it kind of hit the market pretty hard.
Yeah, it was a little bit of a surprise. And the market's been so strong for the last N weeks, 7-8 weeks, whatever it's been. You get in this habit of if you can't beat it, join it, and you start looking for any opportunity to get a pullback to get on board so you can ride the train again. Although yesterday, that little pullback, I'm like, ooh, this one feels bad today. It just didn't feel right. Any call you sold as that was happening expired worthless in SPX. It felt like. So it was a tough one.
Yeah.
It ran
pretty hard too, and it was kind of discouraging. It was like, everything was pointing bullish again for yesterday, and then they decided for whatever reason, hey, today is the day.
Yep. Mark, sorry, what were you going to say?
I was just going to say that when the train's been going the same direction for so long, any whisper of a change, you get that kind of like quick pivot from people. Right. So I think there was a lot of that. You thought the merry-go-round was going to keep spinning, so you're much quicker to get off if you've kind of gotten caught up in the euphoria.
I think I rolled down my call side. I had an iron condor on in the SPX, and it was so far away. I was looking at the puts. I'm like, there's no chance I'm gonna go hit hockey pucks somewhere. And then it starts happening. I'm like, ooh, those are getting close. And then all of a sudden they're in the money. And I'm like, wait a minute, this isn't right. This isn't supposed to happen. So I can't tell you how many call rolls I did. I think I did 8 call rolls yesterday.
Wow.
Down.
It wasn't very liquid either on the way down.
I know. Well, the XSP went from, normal markets, not really great, tight, to $1 at $8. I can trade that if I'm a market maker. I was like, geez, 1.8. What do you want to do?
Right.
All right. Okay, let's talk about this white paper. That's what we're supposed to be talking about. So I read it. Mark, I think you read it. You had some comments in it, I saw, or at least a footnote. The most interesting part to me, and this was confirmed by SIBO, was that gamma isn't as big of a factor as we once thought it was. There's other sub-Greeks, second-order Greeks, that seem to have more of a profound effect on dealer positioning, and which can also have an effect on which way markets kind of drift or move. So, Jason, I'm going to tee it up there and let you explain.
Yeah, well, I mean, first, we'll talk about what the purpose of the white paper was. And it was, I have an economics background. And, we did, I have a master's, and we do a lot of econometrics, and, I've had to take a couple econometrics classes, and, I've kind of come to the altar of linear regression. And so, I mean, I kind of see that as one of the most compelling data, data kind of visualizations. And so, at Volland, we try to estimate the dealer book. That's that's basically Volland's mission. And we decided, let's try to take our data, see if it does actually correlate, see if it does what we say it does. We kind of knew it did, but we wanted to write something that shows, okay, this is what our estimated dealer positioning is. This is its effect on the market. And, just kind of bring those two components together and see what we can see. And I mean, while I was writing this white paper, to be completely honest, I learned a lot. There was some, I wasn't ever really wrong, but kind of like what you said, I believe gamma had a big impact. And, we'll see in a minute, maybe not so much, then kind of learning these things as I was going along. So,
right.
Is my screen up? I'm just on my PowerPoint.
No, not yet. Let me,
okay.
I think you unshared it. So go back and share it.
Oh, I unshared it.
Yeah, you unshared it. It's
okay.
Part of the unsharing part.
Yeah, I'm not a big, yeah. Let's see.
We will send you a document on sharing.
Yeah, can you send me an instruction manual?
Yeah, I will. Do you have that thing in full form? Where you
hold on, it's coming up. There we go. Is it shared?
It's in present mode? Well, would you look at that? It looks like some regression analysis or something.
This is a regression analysis, yeah. I mean, in the white paper, you see like all the regression statistics. We're just going to talk about it, right?
Yep.
So this was the first. I mean, other than we talked a little bit about spot vol correlation and, kind of hinting that dealers probably have a bigger part to play in the market moves than most people kind of want to believe, I think.
Yeah.
But we started hunting through each of the Greeks and seeing, what actually has correlation. So this is a correlation of the delta change from the day before. That includes delta change through gamma and market moves. And you can see it is correlated. I believe the R squared on this was around like 0.29, 0.3 area. It's a little bit spread out, especially if the market's going down. That the delta gamma kind of starts spreading out pretty hard.
Okay.
But like when I was doing this, I was expecting a lot tighter correlation than this with delta. I mean, delta by definition is the number of shares that dealers have to, or the amount of the underlying that the dealers have to hedge their option book with, right, in order to become risk neutral. So I was expecting it to be a little bit tighter, but then when we did a Vega hedging, next slide, whenever my mouse decides to do this.
Can I repeat this in really dumb terms, what this is showing?
Yes.
So like this is basically saying that if a dealer goes from short 1,000 deltas to flat, they've gotten longer 1,000 deltas, and that positive change in dealer position from yesterday to day today has a positive in R squared of 0.29 of explaining the future change in SPX on that next day. So as dealers are getting longer, the market's going up. As dealers are getting shorter, the market's going down.
Right. And the reason why we did daily is because that is the time frame in which, there's like a checkpoint every day, and when dealers have to see what their exposure is and try to mitigate the risk of their book, right?
Right.
Yeah, they don't do it hourly, so hourly doesn't work.
Yeah. Okay. Are you trying to move your slide? Oh, you got it. Okay.
Oh, no, I was about to do it. We just started talking about it. So
got it. No worries.
All right. So this is Vega hedging versus SPX percent change, and this had a lot more compelling results. You can see
it seems tighter.
Much tighter. It was I think it was like 0.56 R squared or so. Especially right here in the like kind of unchanged area. It's much tighter. And even when the data points stray, they kind of stray in similar directions. When the market is going up very strong, then we see a larger change to the upside. When the market's going down very strong, we see a larger change to the downside. So the other kind of funny thing is the Vega hedging versus the SPX percentage change. This is basically the inverse of the spot vol correlation. It had the same slope, although inverse, because dealers hedging means they're going inverse to the movement of the underlying. And and I mean, the intercepts are always pretty much like right in the middle. And so we kind of thought that, I mean, inconclusive, but there was a pattern here to say that spot vol correlation may be caused by dealer Vega hedging, as opposed to, when I read books and I kind of popular belief thinks that as the markets go down, customers are buying more puts, so the implied volatility goes up. I think that happens sometimes, but I don't think it's if the market goes down 0.2%, I don't think there's that many more puts being bought to move implied volatility. So I kind of this was a lot more compelling to me than
I would
Delta.
think, though, Mark, tell me what you think here, but I would think that the Vega hedging part would not have as a profound effect on dealer book management as the previous slide would. That's just from the old days of being in that business. I would say we sat with Vega way more than sat with Deltas for sure. Delta was an ongoing, sort of battle of sorts, depending. Whereas Vega, we could kind of, let run a little bit, but it didn't really play as hard. I don't know. What do you think, Mark? I'm surprised at this one, I think.
No, I think actually your intuition is exactly correct, is that like dealers are sitting on the Vega and that's their business, is warehousing Vega. Like they don't flatten their Vega at the end of the day the way they flatten their Delta. And generally there's like, they warehouse it both long and short, but then also I think you're probably going to get to this, Jason. I don't mean to steal your thunder, but like across the term structure too.
Yep.
That like in general, there also tend to be holders of duration that people tend to buy long-term Vega from dealers, and dealers tend to be short. They tend to be short the duration of Vega because I think there are structural economic reasons why they're the only people in the market that can warehouse that and wear those fluctuations. But their fluctuations as to where the market goes on a day-to-day basis are pretty muted because they're relatively delta flat and like hedging that daily. So my question with the Vega is, if like this seems to jibe because on up days, they're going to be buyers of Vega, because in general, you'd expect that like price action and market clearing price of like variance to be lower as the spot vol correlation holds, and markets go up, vol goes down, markets go down, vol goes up. Like I think there's like two things. They're both moving the Vega and collecting the Vega. That's like what being that like market maker is. So like I think it's totally economically sound, I guess, that this is the inverse of the spot vol correlation and like underlines it.
Yeah. Well, I think the other thing too is, I mean, I don't go deep into that in this PowerPoint, but I think that we used VIX as our like implied volatility proxy to determine, okay, this is how much dealer Vega is, this is how much VIX moved, this is how much, in dollars, I guess they would have to hedge. And VIX is 30 days and shorter, whereas most of the dealer Vega is in the out, in farther out than that, the 3, 4, 5, 6 month area.
Yep.
And they're negative Vega, and that's the Vega they like to warehouse. Apparently, very little Vega is in the front month. So we end up positive gamma and negative Vega, or the dealers do. Positive gamma and negative Vega, which means they're kind of basically like short calendars as far as their book is concerned. So I think, honestly, what I think they're doing is they're hedging that near term kind of Vega and letting the deep one, which is kind of in size, the largest parts of their Vega, and letting that run. They warehouse that. Like you said, that, and when I was talking to our good friend Henry. He said that dealers hold maybe at best 25% to 30% of their hedging Vega through like VIX products. Mostly, if they have to, they do like a dispersion kind of thing where they take like SPX Vega and hedge it with, like a basket underneath, Apple and Tesla or whatever. And based on our data, like what we see, they probably do a lot with SPY. I mean, SPY is probably about a third of all options traded. Like, not notional, just, flat number options.
Right.
And so I think this, when we see this correlation, I think what we're seeing is near-term Vega being managed a little bit more actively, and that far-term Vega, like you guys said, I think dealers like it.
And I think I know you're mostly focused on the SPX here. And like, I think it's interesting to point out that like the intersection of SPX market makers and dealers and like other equity dealers is not that large, that there tend to be firms that specialize in the SPX complex, and there tend to be firms that specialize outside of it. Now, like there's definitely some of like the ETF bleed, of course, like, your Citadel, Susquehanna's, Wolverines, Group Ones, like they're trading SPY and whatnot because that's like an equity or an ETF. But like fundamentally, these are different camps. And so their Vega management is going to be a little bit different. That like in some ways, if you're trading a basket of equities, you can do more Vega hedging across the book. Whereas in SPX, if you're only in that domain, like your options are relatively limited.
Yeah, that's a good point. It's a good point. What's the next feature here, Jason?
And the next slide. All right. So this is when, we were just talking about how dealers like to be negative Vega and they like to warehouse it. This is what the aggregate Vega was in our data set. So back from 2017 to 2022.
Okay.
One thing I like to point out, 2022 was kind of like a bear market. There was the lack of liquidity. And we saw strong negative Vega. So, I mean, obviously there was people hedging in puts longer out. And that's what we saw in 2023. We saw a lot of puts, in the June, July timeframe. And then when the bank crisis happened, we saw it explode. Like, there's tons of puts in the out month. So I think dealers were very, very happy when all that happened and turned out to be nothing. Or it turned out to be managed, let's say, not nothing. We saw this too, like in this year. I would have to go out and get the graphic, but this year we averaged about negative 900 billion in Vega, except over the past like 2-3 weeks, when markets rose from that 4,100, we were down at like the negative 1 trillion Vega area. But then when we shot up to 4,700, nobody rolled their short calls, their short-term short calls. Nothing, really there was very little option imbalance in that time. There was a lot of volume, but a lot of imbalance. And dealers got very positive Vega. And I was kind of saying it on Twitter a bunch of times, and that beware, because we're going to see like an acute drop when this starts rolling off, and dealers have to start buying back their vol. And yesterday was VIX expiration, so it made sense that yesterday was a start. A lot of that positive Vega is going to come off the books in January OPEX. So even though yesterday was kind of like a pretty jarring hiccup, I think a much larger hiccup will be coming in January after OPEX.
So I should keep my short QQQ positions intact.
I don't know when they expire.
They expire after around Jan OPEX, let's say.
Then that's no. You would want it out in duration. Like, Jan OPEX, we could drop a bit, but we could also bounce back up. It's going to be Christmas season. If the dealers start going negative Vega, and they're not going to do anything like they did yesterday.
Yeah.
Which I do think it was them kind of yesterday managing their book. We could bounce in January. I mean, that's not out of bounds, but I think though at January OPEX, that's when you're going to want to short your QQQs, not to there.
So you're saying maybe get out in February and beyond.
Yes.
Okay. All right.
But I would even wait. You might get a better price.
I'll think about that roll in a couple of weeks after the holidays and after all the food I'm going to eat and wine I'm going to drink. Then I'll think about rolling.
Yeah, that's what I was saying. Like a couple of weeks, something like that. You might want to. You might want to think about it. You might get a better price for it putting on something like that now.
I got you. All right. What's next? I want to get to the second order Greeks.
All right. So then the next thing we were talking about was Vanna, and to contextualize Vanna a little bit, I'll go through the litany of definitions that people give Vanna. It is the movement of delta relative to implied or volatility moves, not even necessarily implied volatility. Most of the time it's realized, but anyway, depending on how you measure it. It is the movement of Vega based on the underlying, which is what we, kind of been using it for. It is the slope of your Vega curve. So if you are, Vega kind of gives you a distribution of, how high Vega is in relation to the option. With Vega being the highest at the option, it is the slope of that curve. So when you look at something like extreme positive Vega or Vanna, I'm sorry, then, dealers are typically negative Vega. So they have like a kind of a U that's negative in Vega. And so we are on the right side of that curve, right? And then, so those are kind of the mathematical definitions kind of Vanna. When all the time on Twitter and, everywhere you see people saying, oh, there's a Vanna effect, we're going to go up. What that is trying to say is dealers, Vanna is, because it's the slope of the Vega curve and implied volatility kind of premiums kind of drop. It's more like a charm kind of thing more than it is a Vanna kind of thing. Then we will go up as long as there's positive Vanna, as long as you're on that side of the curve. And so what this is kind of a stochastic. It's what the current Vanna slope is compared to how it could be maximized. We were trying to figure out a way to visualize it because Vanna doesn't correlate with market returns directly. Okay. But it does kind of through Vega changes. So this is kind of what we came up with. And you kind of see a lot of Vanna curves as far as, at least from academic papers. So we kind of assume that they use, 23 to 30 day realized volatility as their volatility metric.
Yep.
And so it seems like maybe about a month or two prior to drops, you will see that the stochastic kind of changes or hiccups or, you can see kind of shakes in the stochastic. So this around here, Vanna stochastic is around 1, right? It has actually been for the past couple months. This is in our data set though. And as a result, you see there's kind of this strong move up. Over here, you see it start hiccuping right before COVID. And then we see a COVID drop. It kind of more allows drops, right? Yep. Here you see it's starting to go up. It goes up. When it's hiccuping here in the like this kind of area, It kind of stays stable, but then drops down, right? So, I mean, it isn't like a strong, we tried to do it without, kind of releasing a lot of what we do with Vanna in the background, with like our own algos and models and stuff. But we're trying to visualize it. We're gonna probably do a white paper strictly on Vanna in the future.
Right.
But this is just kind of like a start.
So this second order Greek Vanna, this isn't as profound in 0DTE as Charm is. This tends to deal with a little bit more of a time frame. And I guess there's an argument, does 2 years out really mean anything? My argument would be no. Closer to 30-day, 60-day, 90-day Vanna figures might be very interesting, because that will have a profound effect on dealer position as that moves around. And just in layman's terms, real simply, if dealers are long calls, out of the money calls, what is their Vanna position? Just so people understand what we're talking about.
So if dealers are long calls and they're out of the money,
okay,
then that means their Vega is, it's going to look like this, right? As opposed to normal, that it would look like this. But right now they're kind of long calls, so their Vega is positive. Okay. And if it depends on where on that Vega curve that there is. So if their calls are out of the money, then that means that Vanna will be positive, because you're on kind of the left side of that positive parabola. You're up here, right?
Yeah, but
how's my hands?
Yeah, I know. You look like you're doing like origami or something. So what I want to just get to though is, so they understand simply, is that out of the money calls, if dealers are long these, they are probably short stock against them or something else, right? Potentially. So if that implied volatility goes higher, those deltas are going to get bigger, and their hedges are going to become skewed. So they're going to get longer deltas.
Right. Yeah. Vanna shows skew of their distribution.
Okay, good. I just want to make sure that is clear, so that people get what's going on there. Okay, good.
Yeah, that's a really good point, because if your Vega is like this and your positive Vanna, their delta distribution, which is their implied distribution of returns, is going to look more like this.
Yep.
All right. So positive Vanna shows positive skew. It doesn't inflate or deflate the tails. That's VAMA, but or implied volatility itself. That shows kurtosis. But yeah, it'll skew this way. What we've seen recently is, we are in the throes of customer short calls, so dealer long calls.
Yep.
That's how we got to positive Vega. And now what we've been seeing recently is Vanna kind of shrinking. This metric kind of getting a little shaky.
Yep.
I thought it was getting shaky in preparation of January. I mean, yesterday I think we got some hints that January is going to be tough, especially if we bounce.
Yep. Okay. Let's do this. Let's do one more. Do you have something on Charm real quick? Because we're running long.
So this is more swing time frames as opposed to 0DTE. We could do 0DTE another time.
Okay, that's fine. That's good.
But Mark, I got one more slide.
One more slide. Mark, what are you thinking over there? Are you thinking about? I know what I'm thinking. I'm thinking about what wine am I going to pull out of the cellar tonight? That's what I'm thinking. But besides that thought, what are you thinking?
Well, now you got me thinking about that, so I forgot what I was thinking about before.
Mark, you're looking like a lumberjack. You're probably getting box wine.
No, I got some good stuff. Got some Shun Nifty Pop that I'm trying to hold on to until Christmas.
Yeah, I love it. I love it.
So this last slide is the dealer implied gamma hedging, and you could see it is inverse market moves generally, right? I mean, which to me, this was shocking. I thought that it would just be maybe less correlated, but still positive. And it started running contrary. And this kind of shows about the negative Vega, positive gamma relationship that dealers have. And I had to kind of proof it through the data like 3-4 times because I was not expecting this.
So explain this though. When you say it's inverted, just to make sure we understand it. So
it's going the other direction. So basically, if the implied gamma hedging is negative, right, on the x-axis, below the x-axis, the market's actually going up, even though dealers are selling into it because of gamma.
Mm-hmm.
But, as we saw, they are stronger in buying into it in Vega. So personally, I was expecting, going all over the place, right? Like I was expecting it to be more fanned out, but still positive.
Yeah.
But because gamma was positive and Vega seems to have implied volatility changes have a much stronger effect, according to the data.
So Vanna is a more powerful metric than gamma is in terms of movement.
Vega plus Vanna. Yeah.
Vega plus Vanna. Interesting. I would think, and there are probably exceptions, right? So, I'm going to go back a couple of years here to the GME days, GameStop. It had to be a combination of both, though. So if dealers have short upside calls, they've got a gamma problem. On top of it, you have a Vanna problem because implied volatility is skyrocketing in those out of the money calls, right? And it's making them shorter and shorter. And the gamma is also exacerbated. I might be saying the same thing, but it could be a double bounce sort of effect. You've got a Vanna issue and you've got a gamma issue, and therefore dealers are, just absolutely reaching for it.
Yeah, I mean, I kind of wish I had the history of GME, or maybe that'd be an interesting paper to write. It's about the history of dealer positioning back then, because I think people were assuming that everybody was long calls. I think probably to an extent they were, like Roaring Kitty or whoever.
Yep.
All of them were probably long calls, but Roaring Kitty, despite the fact that he made millions on that trade, I don't think he's creating the volume. I don't think he can move the markets. Even with all the people.
Yeah, he couldn't, but the catalyst of everyone jumping on maybe could, only because of the sheer small, just small size of open interest in GME at the time.
Yeah,
exactly.
Right? Because it wasn't like an SPX kind of product. It was probably very lightly traded. All of a sudden, he starts buying from these dealers, and then everyone jumps on, and the dealers are like, "What the hell just happened? What's going on here?" And then the fire burns, and the fuel gets worse, right?
Yeah.
And then all of a sudden, the hedge funds are short this stuff, and they've got to cover too. Don't forget, right? So it was quite the conflagration. Is that a word?
Yeah.
That'd be
It's amazing how little volume it takes, and especially volume from disparate sources, right?
Right.
Like if there was one block 10,000 lot that comes into GME, sure, people will warehouse that and that'll be fine. But when all of a sudden every different broker is getting peppered with 2 lots and 10 lots and 20 lots, like here, there, and the other way, like that starts to get like to be a swarm, and you're like,
well, you know how it was, Mark. You know how it was in the day on the floor when that happened to us. We're on the opposite end of that. Your first thought is, what a great trade this is, right? I'm hedged. Second thought is, why are they continuing to buy this? I'm suspicious. The third time they come out, you're like, something's up, right? Someone knows something I don't know, and now I'm scared, right?
Yep, and that just starts the frenzy, right? Like everything just starts shifting, and
so interesting. Okay, Jason, that's good stuff. Let's pick this up again. I'm sure you'll have some more details for next week. But this is good stuff.
And next week we can talk Zero DTE.
Yeah, we'll talk Charm and Zero DTE. I've been doing a lot of that as I've said in the past. But
are we doing that? Are we doing that next week or the week after?
You tell me. We can do it next week.
Are we doing a show next week?
I'm available next week, but I don't know if anybody else will be watching.
Well, that's true. It's New Year's and there's a lot of football games on. No, but this is good stuff. And I know people see this and be like, God, I'm just a retail trader and I don't need to know. You might not need to know this, but man, I can tell you, it sure can help you in terms of getting your positions on and understanding what's going on behind the scenes, right? You may not be able to derive the model. You may not be able to understand all the mathematics, but you know what they mean when you see it. That's the important thing. So learn what it means when you see the red light or the green light or the yellow light, right? You don't have to know how that produces it, but just maybe understand what the value is. Mark, you're smiling, Mr. Lumberjack. What do you got?
Green means go.
Green means go. That's when I hit the gas after I look both ways. I'm so safe. I always have extra calls and puts on both sides.
It's the opposite in Japan, though, right?
That's right. All right, boys. Good seeing you. Have a great Christmas, and I'll see you next week. Good deal?
Merry Christmas.
All right, boys.
Merry Christmas. Happy trading.
Happy trading.